For dividend investors, there is nothing like the smell of a good dividend increase in the morning. Today, we're going to look at several companies that announced increased dividend payouts this week. Each one increased by 10% or more, and you'll definitely want to stick around to see the last one on this list, since it increased its dividend by 50% and is up almost 180% in share price alone over the last year. Time is money, so let's get moving. Dividend increases are basically a company's version of a pay raise. Fortunately for us, we don't have to go through a performance review to get that increase. We just have to have a little bit of faith and hold. So let's dive in and see what rewards your patience can bring. We're kicking things off with First Bancorp, ticker FBNC. First Bancorp is a regional bank that's been around since 1934 and is located in North Carolina, with branches in North and South Carolina. It primarily works with individuals and small to medium-sized businesses and has a market cap of $1.65 billion. Quick side note, I am a fan of regional bank stocks, provided you do proper research, and they have performed really well for me in the past and present. On Monday of this week, FBNC announced a dividend increase of 10%, raising their payout from 20 cents to 22 cents per quarter. They also announced that they'll authorize a share repurchase program of $40 million, which is always welcome information for investors. This 88-cent annual payout will put their dividend at just under 2% as of the making of this video, and their dividend history looks rock solid over the last 5 years. Their yield spike, of course, during the pandemic, but has since hovered in the 1.5% to 2% range. They paid dividends for 32 consecutive years and have increased those dividends in each of the last 4. Their 5-year dividend growth rate comes in at around 20%, so they've definitely been on the right track lately. And they have a solid payout ratio of 19.74%, leaving plenty of room to continue increasing dividends in the future. The trend on revenue has significantly increased over the last several years, and the future revenue estimates look to continue that rise. Earnings per share currently sit at 3.85, which is within a few percentage points of its highest mark at the end of the third quarter last year, and all signs for the upcoming years look up. Total return for the last 12 months is 19.5%, and the 10-year return comes in at just over 400%, beating out the S&P 500 in both time periods. It has a forward PE ratio of 11.63, which is comfortably below its 5-year average, and its share price currently sits about 11% off its 52-week high. There's no reason it can't get back there, and if it drops just a little more from where it is now, I'd definitely consider it in the buy range. Next up, we have a well-known dividend aristocrat, TROW Price Group, ticker TROW. TROW provides investment services to both individual investors and institutions, as well as retirement planning services. It's based in Baltimore, Maryland, and has been operating since 1937. This large cap has a market capitalization of almost $35 billion, making it the largest on today's list. On Tuesday of this week, TROW announced a dividend increase of just over 11%, raising their quarterly payout by 12 cents per share up to $1.20. This increase beat the analyst estimates, which had TROW only increasing their payout by 5% to $1.13. The $4.80 annual payout will put their dividend at 3.13%, and they've continued to grow their dividend very consistently. Looking at the history, we see 2 spikes in dividend payouts that make it seem like they cut their dividends the year after, but those are actually special dividend payments. For example, in 2021, TROW paid a special one-time dividend of $3 per share in addition to their announced normal annual payout of $4.32. You gotta love a good bonus. They've paid dividends for 35 consecutive years and increased those dividends every single year as well, even paying one of those special dividends 3 times out of the past 10 years. They really have been the model of consistency. Their 5-year dividend growth rate comes in right at 15%, which is well above the average dividend growth rate. And they have a comfortable cushion for payout ratio, sitting at 34%, signaling safety for investors. Revenue's climbing consistently and is up 23% year over year. Earnings per share at $12.75, which isn't too bad, but slightly below the company average over the last 5 years. TROW is down just under 6% over the last year, not counting dividends, and up around 168% over the last 10, so it's not very attractive for growth investors and should be considered a pure dividend play. It has a forward PE ratio of 12.56, which is below its 5-year average, and its share price is way below its 52-week high by 32%. Again, this stock is not a growth stock as of late, but it was at one time, and it's currently undervalued and poised for some recovery gains going forward. Let's move to our third stock on the list, Radian Group Incorporated, ticker RDN. Radian is headquartered in Philadelphia, Pennsylvania, and it's a mortgage and real estate services business. It provides private mortgage insurance for residential loans as well as other credit management services. They also offer real estate title services, including recording and document retrieval. They have a market cap of $4.3 billion, and its stock price is on a recent run-up since right right before Christmas of last year. Earlier this week, Radian announced a huge dividend increase of 43%, raising their payout from 14 to 20 cents per quarter. They also announced they'll authorize a share repurchase program with a budget of $400 million. Now that's what I'm talking about. This 80 cents per share annual payout will put their dividend at 2.38%, and it's an awesome win for investors owning this stock. Imagine a 43% raise for nothing other than being there. Where do I sign up? One thing to note here is that Radian is relatively new to the dividend market as far as any significant dividends are concerned. Even though they paid dividends for 22 consecutive years, you can see that their yield really didn't go anywhere until early 2020, hanging out at around 0.04% until that time. But since then, it's absolutely exploded and maintained those higher rates. Their 5-year dividend growth rate is an astounding 122%, growing at a blazing speed. They have a very low payout ratio of 19%, leaving a lot of room to keep their new dividend investors extremely happy. It is important to note that revenues are down about 6.5% year over year. Earnings per share are back on track at 2.86 after taking a hit during the pandemic and are expected to be at record levels in 2022. Total return for the past 12 months is 13%, and RDN is up over 550% over the last 10 years, beating out the S&P 500 over the latter period. It has a forward PE ratio of 8.4, which is right in line with its 5-year average, and its share price is 7% off of its 52-week high. I'll be honest, this one was not on my radar at all before, but if it drops down in the $20 per share range, I would consider it a buy. And last on our list is Danos Corporation, ticker DAC. I believe that Danos is an undervalued name in container shipping and as a company as a whole. Danos Corporation is one of the largest independent owners of modern large-size container ships. They charter their container ships on long-term contracts at fixed rates to many of the world's largest liner companies. They have a conservative and disciplined approach to fleet growth that has positioned them very well to exploit market opportunities during periods of low ship prices and reduced demand. They have a market cap of $2 billion and are currently enjoying exponential growth. On Monday, Danos announced a dividend increase of, are you ready? 50%. Now that is what I call magic in a bottle. This increased their quarterly payout from 50 cents a share up to 75 cents a share, really setting the bar high for future growth. The $3 annual payout puts their dividend at a market-beating 3.09%. It is important to note that they're relatively new to the dividend scene and only started paying dividends in 2021, but they've done so in eye-catching fashion. If you've ever said, man, I wish I'd gotten in on those crazy dividends at the beginning when looking at a stock, don't say I didn't bring you any options. They've only paid dividends for 2 consecutive years, but they started right out of the gate last year with a 50-cent dividend, and this year pushed the envelope with that increase to 75 cents, piggybacking off their impressive growth and expansion. Their payout ratio sits at just 12.79% even after the massive dividend increase, ensuring plenty of room for future growth, and their board has made it clear that dividends are a focus for the company moving forward. They've not yet announced any share buybacks, but it is expected that we'll see something related to that in the very near future. Revenue looks more like a rocket ship than a sea vessel over the last few years, climbing from $451 million in 2017 to an estimated $876 million for 2022. EPS came in at 6.1 for Q4 of 2021, crushing estimates of 4.95 and is climbing consistently, beating estimates in each of the last 5 years. Right now, there's an expected 50% increase in year-over-year EPS throughout 2022, showing massive upside even after their stellar 2021. Danos is up an insane 179% over the last year in share price alone, really skyrocketing after their recent investment in Zim Integrated Shipping Services, a very profitable venture and very well received by the market. It has a great forward PE ratio of 3.95 and is really poised to continue its growth. Even though it currently sits at its 52-week high, it shows no signs of slowing down, and all analysts covering the stock have it rated as a buy. Its revenue and profits are on track for solid continual growth throughout 2022 and should be an interesting play for any dividend growth investor with a little risk tolerance, considering its beta of 1.4. Even today, with the market down as a whole almost 2%, Danos is carrying a 1.76% return into the bell. Thanks for hanging out with me and checking out these amazing dividend increases from this week. If today's video helped you out in any way, pop that like button and subscribe to join the Cash Flow Nation. I'd also love it if you dropped a comment below and let me know what dividend stocks you're truly excited about right now. Thanks and see you next time.